After falling by 50% since June, it seems crude oil prices have in the past few days started a bit of a rebound. But as the FT's James McIntosh recently noted, the return might not be an indication of recovery. But as it stands, the price dip, as widely expected, did put quite a pinch on recent oil earnings. With the earnings seasons now concluded, we thought it time to check in with the FT's U.S. energy editor, Ed Crooks. Ed, thanks for joining us.
Thank you.
So Ed, the numbers are now in. From your point of view, what do the companies see? Has the price started to turn a corner?
No, they're certainly not saying that the market has turned a corner yet. I think really they're putting it in terms of the short term and the long term. In the long term, they're definitely banking on a price recovery. And we heard, for instance, John Watson, who's the chief executive of Chevron, talking about this. And he said, really, when you look at what's going on here, essentially low prices are self-correcting, that when prices are low, projects get cancelled. He said there's a lot of projects just won't work with oil prices around $50 per barrel, which is roughly what we've got at the moment. So people don't invest in the industry, so production falls. That tightens supply, that puts pressure on the market, and that puts prices back up again. And that's generally the consensus view in the industry, is that prices will be higher in the long term. As he says, the world needs energy. Somehow we have to get that oil, and prices have to be high enough to incentivize that oil production. And he thinks that's a price significantly higher than we are at the moment. Similar thing from BP, for instance, where BP say for their long-run planning, they use a price of $80 per barrel. They've been using that for a while, even when prices were much higher, even when the price of oil was $110, $115. They were still using 80 in their planning. Now prices are down at 50, 55. They're again saying we still think $80 is the right long-run price. However, all of that is a very different thing from them saying we think we're going to get back to those kind of levels very quickly. And so they're saying that's really where there's a great deal of uncertainty, and they certainly think that they as an industry, as companies, they should be preparing for quite a sustained period of low prices, just in case. Essentially, they should be prepared for the worst.
So in this period of uncertainty, what other areas of fallout has there been?
Well, for a start, a big drive down on costs. And so the thing that they're all trying to do is cut costs wherever they can. So we're having job reductions. We're having very tough negotiations with their suppliers. Again, BP talking about putting pressure on their suppliers. They're trying to get reductions of 20 to 30%, they think, or that's what they think they're likely to be able to get, 20 to 30% reduction in the costs they are charged by their suppliers over the next 18 to 24 months. And we're also seeing a big slowdown in activity. Different picture for different companies. So for instance, again, BP, one of the more aggressive, they're talking about a 20% reduction in their capital spending this year, the money that they spend on drilling and drilling wells and bringing them into production and so on. Other companies have smaller reductions. Chevron talking about a 13% cut. From Exxon and Shell, we haven't yet had precise details, and it's likely that their cuts will be even less than that. Exxon and Shell, the two biggest companies in their respective markets, Exxon the biggest in the United States, Shell the biggest in Europe, seem to be able to sort of carry on going without so much fluctuation, without so much variation, without needing to cut so aggressively, but still reductions pretty well across the board in what the industry is spending. And again, when you go down from those really big oil companies down to the smaller ones, then we're seeing much deeper cuts. And so that's really where the industry gets this idea from, that there will be tighter supplies and higher prices in the future because of these capital spending cuts now going on.
So amidst this upheaval and contraction, what's the chatter about deal making?
Well, there's something of a slowdown in deal making at the moment, because while prices are volatile, it's hard to get buyers and sellers to agree. Nobody wants to buy at $60 and then find that the price has gone down to 40 and you've missed some great opportunity, you've bought it at too high a price. And likewise, no one wants to sell at $50 and find that the price then goes to 80 and you sold out too cheaply and too soon. But when we get stability, I think there's a general expectation there will be a lot of deal making, particularly companies that are under pressure, that are in distress, will be looking to sell and be looking to sell assets, or even sell entire businesses, and for companies themselves to be bought. And when you look at the buyers, the big oil companies are the ones with the greatest financial strength. They're really going to be the ones that are going to be out there in the market making acquisitions. And in particular, I think the one to watch there is going to be ExxonMobil, the world's largest listed oil company. It's got a AAA credit rating. Its debts have been rising, but still it's got enormous financial firepower. They could do really quite a significant deal. And it was very interesting when they talked about this on their call, when they were executives were talking to analysts and sort of explaining their results this time around, they talked about being alert for possible acquisition opportunities. They talked about being watchful. There was a lot of kind of messaging there that said, I mean, they talked about bolt-on acquisitions, so not necessarily doing huge deals, but still, I think that's definitely going to be one to watch, is what is ExxonMobil going to do? Who are they going to buy? And I think it would be a big surprise if in a year's time we didn't find that they'd done some significant deals. One of the things about ExxonMobil is it has to buy really to sustain its growth. A company of that size, it finds it very hard to grow without doing deals. And so I think, as I say, if you were looking to who's going to be a buyer out there in the market, Exxon is the one to watch.
So the big guys will essentially get bigger.
I think that's very likely, yes.
Well, never a dull moment in your corner of the world, Ed. I'm sure we'll be coming back to you throughout this. Thank you so much.
Thank you.